Today, we're really getting into something significant shaking up global trade.
Yeah, it's President Trump's proposal for a 50% tariff on all EU imports. That's huge.
And on top of that, a 25% tariff for smartphones not made stateside.
Right. And, that initial June 1st deadline, it's been pushed to July 9th, gives some breathing room for talks. But it's still a major, major escalation in, let's call it, protectionist policy.
And we know you want to get your head around these complex issues, like, quickly but properly. So that's our mission today.
Exactly. We've sifted through, a ton of stuff. News articles tracking every development, economic analyses projecting the impacts, geopolitical reports.
So we're doing the legwork.
We are, giving you the crucial takeaways on what could be a really world-altering economic shift without, drowning you in all the jargon and detail.
Okay, let's unpack this. What actually sparked this latest tariff threat? What was the immediate trigger?
Well, the main reason seems to be President Trump's frustration with the trade negotiations with the EU.
He hasn't been quiet about that.
No, he's been pretty blunt, saying talks are going nowhere, calling the EU very difficult to deal with, and a big sticking point, the EU's offer of zero-for-zero tariffs.
Meaning eliminating tariffs entirely between the U.S. and EU.
Right, on industrial goods anyway. But Trump rejected that. He's insisting on a 10% baseline tariff for most imports.
And it wasn't just a general unhappiness with the EU, right? He singled out a specific industry.
Oh, absolutely. Smartphones. Explicitly called out Apple and Samsung. Said they need to make their phones here in the U.S. or face that 25% tariff on imports.
Which is interesting because doesn't that contradict earlier claims about who pays these tariffs?
It really does. The idea that foreign countries just absorb the cost, this strongly suggests otherwise. It implies pretty clearly that the companies, and let's be real, ultimately American consumers, would bear the brunt.
Right. This definitely sounds like the start or maybe escalation of a trade war. Can we just clarify what that term actually means?
Sure. A trade war, fundamentally, it's an economic conflict. Countries use trade barriers against each other. Tariffs are the big one, obviously.
And it's often tit for tat.
Very often retaliatory, yeah. One country hits back against another's restrictions. The stated goal is usually, protecting domestic industries.
But the consensus among economists is
overwhelmingly negative in the long run. These things tend to hurt overall economic health, even if specific industries get short-term protection.
So beyond tariffs, what other tools get used in these conflicts? What's in the trade war playbook?
Well, you've got import quotas limiting how much of something can come in, subsidies, governments helping their own industries financially,
okay,
currency devaluation making exports cheaper, and then the really heavy stuff like embargoes, outright bans on trade.
Yeah, we saw markets react pretty wildly to the initial announcement and then again to the delay. What's going on there?
It's fascinating, isn't it? It really highlights how much markets hate uncertainty. Stability is key for them.
And tariffs are the opposite of stable.
Exactly. They introduce instability, potential cost increases, disruptions, so markets dip. But then, when the threat gets paused, like with this delay to July 9th...
you see a relief rally.
Right, a rebound.
Yeah.
Because that immediate uncertainty eases off. But, and this is crucial, these pauses aren't solutions. They're just ceasefires, temporary ones.
So the underlying tension is still there.
Absolutely. And that constant policy uncertainty, it really puts a damper on investment, hits confidence. Economists even call it an uncertainty premium, basically, a cost associated with just not knowing what's coming next.
Okay, so the big question, who actually pays these tariffs? Is it the companies importing the goods, the foreign governments?
Yeah, this is key. Despite some rhetoric suggesting, foreign countries foot the bill, the economic reality is different.
It falls on the importer first.
Typically, yes. The company importing the goods pays the tariff levy, and then what usually happens?
They could pass it on.
To pass it on, down the supply chain, and eventually it hits the consumer through higher prices. So the main burden, it falls on U.S. consumers and U.S. businesses.
Leading to less purchasing power.
And more inflation. And it's worth noting, this tends to hit lower-income households harder.
Right, because a larger chunk of their income goes to basic goods, which might now cost more.
Precisely. It's a regressive effect.
Now, the U.S. isn't new to tariffs. There's quite a history here, isn't there? Can we briefly touch on some key moments?
Oh, definitely. Tariffs go way back. The very first Tariff Act, 1789, part revenue, part protection. Then after the War of 1812 and 1816, tariffs went up specifically to shield those early American manufacturers.
And then there was one with a particularly dramatic name, the Tariff of Abominations.
Yeah, that one, 1828. It's a real cautionary tale. The tariffs were incredibly high.
And a result.
Retaliation from Europe, especially hitting southern agricultural exports like cotton, and it massively deepened the divide between the industrial north and the agrarian south of the U.S., really stoked internal tensions.
But the one everyone points to, the sort of infamous example, especially during economic downturns, is Smoot-Hawley.
That's the big one. Smoot-Hawley Act, 1930. Right as the Great Depression was taking hold, tariffs shot up to over 50% on, nearly 2,000 different imported goods.
50%. And the global reaction.
Immediate and severe. France slapped tariffs on American cars. Canada hit a whole range of U.S. goods.
Wow.
The numbers are just staggering. U.S. exports dropped by 66%. Overall, global trade shrank by 65%.
65%?
Yeah. The consensus among economists is pretty clear. Smoot-Hawley didn't cause the depression, but it absolutely made it much, much worse. A total beggar-thy-neighbor policy disaster.
Trying to fix your own economy by hurting everyone else's.
And it backfired spectacularly. Thankfully, FDR repealed it in 1934, and the U.S. shifted towards negotiating trade deals bilaterally. The lesson from Smoot-Hawley isn't just the economic damage, it's the speed of the retaliation and how it spirals. That's the warning for today.
Okay, fast forward a bit. What about President Trump's first term? Tariffs were definitely a feature then, too.
They were. A major re-emphasis on tariffs. We saw the big trade war with China tariffs on hundreds of billions worth of goods going both ways.
Right, that dominated headlines.
Tariffs were also used as leverage to renegotiate NAFTA into the USMCA, and then those 2018 tariffs on steel and aluminum, 25% and 10%.
Justified on national security grounds, wasn't it?
Correct. And notably, the Biden administration has kept most of those steel and aluminum tariffs in place. But yeah, those first-term actions definitely created market volatility, and some are even ruled against by the World Trade Organization.
So how does this current proposal, the 50% on EU goods, stack up against that history?
The parallel that immediately jumps out is with Smoot-Hawley. That 50% figure is just remarkably high, reminiscent of those Depression-era rates.
So history is basically screaming a warning here.
It really is.
Yeah.
Immediate retaliation, trade collapsing, serious risk of an economic downturn. When you see forecasts talking about increased recession risk now, that historical echo is absolutely part of the calculation.
And the reasons given for tariffs, they seem to have shifted over time as well.
Oh, completely. Back in the day, it was mostly straightforward. Raise government money or protect a specific new industry.
And now
Trump's justifications have been, varied. First, it was sort of tax foreign countries to make Americans richer. Then it shifted to reciprocity, needing fairness.
we heard national security used too for things beyond steel, like related to immigration or drugs.
Right. And now the goal seems much more explicitly about forcing manufacturing back to the U.S., like with the smartphone demand.
So it's gone from direct financial benefit to fairness, to security, now to reshoring.
Exactly. And that lack of a single consistent rationale, it makes negotiating with other countries really, really tricky. They don't know what the actual objective is or if it will change again.
Okay, so we've got the trigger, the context of trade wars, the history. Let's get back to the present. What were the immediate tremors when this latest announcement hit?
Well, the announcement itself came via Truth Social. President Trump reiterated the reasons stalled EU talks, needing that 10% baseline.
And the markets, did they blink?
Oh, they did more than blink. We saw an immediate drop. U.S. stocks, the S&P 500, down about 0.7%. European markets, too, like the French CAC 40 slid.
And Apple stock took a hit since they were mentioned.
Yep, down about 3%.
Well,
It just shows that hair trigger sensitivity we talked about. Markets react instantly to this kind of uncertainty, especially when specific companies get called out.
but then things calmed down a bit after the delay was announced.
That's right. Once the deadline shifted to July 9th, you saw a market rebound. A sigh of relief, essentially.
Even if it's just temporary relief.
Exactly. It underscores the point. Markets hate the uncertainty. Even delaying the potential pain provides a temporary boost to confidence and investment sentiment.
So how did the European Union react initially? What was their immediate response?
They went for a kind of dual approach. Keep talking, but get ready to punch back.
Diplomacy first.
Yeah, EU Trade Commissioner Sefcovic mentioned having good calls with U.S. officials. Publicly, they committed to finding a deal by that July 9th deadline. Commission President von der Leyen got involved directly too, agreeing to speed up the talks.
Did they bring up their 0 for 0 offer again?
They did. Reaffirmed that offer for industrial goods, even though the U.S. had already, rejected it, keeping it on the table.
But it wasn't all talk, was it? They were preparing countermeasures.
Absolutely. The EU has already greenlit retaliatory tariffs. We're talking 50% tariffs on about $21 billion worth of U.S. goods.
What kind of goods?
Things like maize, wheat, clothing, and those are scheduled to kick in July 14th if there's no deal.
And that's not all.
No. Reports indicate they're prepping tariffs on a much bigger slice of U.S. exports, around $95 billion. That could hit things like Boeing planes, American cars, bourbon whiskey.
Wow, that's a serious list.
Yeah.
What's the strategy behind this? Why such specific and significant retaliation?
The EU's thinking seems to be that just giving in, appeasement, will only invite more demands later.
So push back now.
Push back now, show they're serious, but keep the door open for negotiation. They want a real deal, not just a fold. And notice the items listed for retaliation.
Bourbon, cars, seems targeted.
Very likely. Targeting goods from states that tend to lean Republican could be a way to create political pressure within the U.S. to find a resolution. It's strategic.
Okay, let's zoom out a bit now. What are the potential broader economic ripples here? For the U.S., for the EU?
For the U.S., the potential macroeconomic hit could be pretty severe. Some analyses are quite stark.
Like what?
The Penn-Wharton budget model, for instance, projects a potential long-run GDP drop of around 6% and wages down 5%.
6%? That's huge.
It is, and they suggest the damage could actually be worse than, say, a big corporate tax hike. The Yale Budget Lab has different numbers, but still significant, maybe a 0.8% hit to GDP growth in 2025, and a persistently smaller economy long-term, costing maybe $160 billion a year.
And Goldman Sachs also cut their forecast.
Yeah, they specifically mentioned these tariffs as a reason for shaving 0.5% off their 2025 U.S. real GDP growth forecast. So multiple sources pointing to a significant slowdown.
And inflation. That seems like an obvious consequence.
A major concern, yes. Yale Budget Lab points out the current effective U.S. tariff rate is already the highest since 1909, around 21.9%. They see these new tariffs adding another 2.2% to consumer prices short-term.
Which translates to how much for an average family?
Their estimate is around a $3,600 hit to the average household. And again, it's regressive.
What about specific items? Are there projections for things like clothes or cars?
Yeah, some specific projections are pretty eye-watering. Short-run price hikes could be like 40% for shoes, 31% for apparel, vehicles, maybe a 15.6% initially.
Adding thousands to the price of a car.
About $5,700 more potentially. Even food prices are expected to rise. And the IMF, they've bumped up their 2025 U.S. inflation forecast by a full percentage point because of this tariff threat.
Now, a key argument for tariffs is often about bringing jobs back. What do the models say about employment overall?
Well, that's the stated goal, reshoring jobs. But the analyses suggest the opposite might happen overall.
Job losses.
Yale Budget Lab estimates around 770,000 payroll jobs could be lost by the end of 2025 due to the tariffs and the retaliation they'd likely trigger.
Which sectors are most vulnerable?
Industries like vehicles, aerospace, pharmaceuticals, energy look particularly exposed. And states with high export volumes. Texas, California, Illinois, places like that.
What about government finances? Surely these tariffs bring in a lot of revenue.
They are projected to, yes. Maybe $5.2 trillion over 10 years, which sounds great.
But there's a catch.
There's a potential catch. If the tariffs slow the economy, reduce investment, maybe make foreign investors less keen on buying U.S. debt, those negative effects could offset the revenue gain, especially with existing deficits and debt ceiling concerns always lurking.
Okay, let's flip across the Atlantic. What's the anticipated economic strain on the European Union?
Well, the EU actually runs a goods trade surplus with the U.S. about $157 billion in 2024. But if you include services, where the U.S. is stronger, the picture changes. It becomes a small deficit for the EU, around $48 billion.
So the EU sees it as more balanced overall?
Generally, yes.
Yeah.
Still, these tariffs would definitely hurt. They're expected to weaken the EU economy, increase the risk of a Eurozone recession. We might even see the European Central Bank cutting rates, partly in response to this threat.
Are there specific EU sectors that are particularly worried?
Definitely. Pharma is a big one. The U.S. is the EU's #1 market for pharmaceutical exports. Huge numbers involved.
Automotive, too, I imagine. German cars, Italian cars.
Absolutely. The U.S. is the second biggest market for EU vehicle exports, though many European car companies do have factories in the U.S., which complicates it slightly. But yeah, car prices in the U.S. would jump, and EU retaliation would likely hit U.S. car exports back.
What about agriculture?
The EU has a surplus there, too, exporting high-value stuff like wine and cheese. But specific areas, like agricultural machinery made in the EU, could get hit hard. And there are long-standing U.S. complaints about EU food regulations anyway, so that's always a sensitive area.
And luxury goods, French fashion, Italian leather.
Yeah, facing a potential 20% tariff, that's significant. For companies like LVMH, the U.S. is a massive market, maybe 25% of their revenue. It hits their costs, access, maybe even client trust if things get messy at customs.
You mentioned supply chain chaos earlier. Can we expand on that? How bad could the disruption get?
The language being used is pretty strong. Upending global trade, sharp contractions, major disruptions. It's not just about the direct trade between the U.S. and EU.
It ripples outwards.
Massively. Especially for industries deeply plugged into global value chains, electronics, electrical equipment, transport equipment. Those rely on parts moving across borders multiple times.
So that kind of trade shrinks even more.
Projections suggest yes. Trade within these complex chains could contract more sharply than direct point-to-point trade. The whole system becomes less efficient, maybe more opaque, as companies try to find workarounds.
We even saw retailers reacting.
Right, like raw stores pulling their financial forecasts, specifically citing tariff uncertainty. That tells you how tangible the potential disruption feels to businesses on the ground.
Okay, so let's revisit the reshoring idea. Is it actually happening? And what's the real trade-off?
Well, there has been some uptick in U.S. manufacturing investment and jobs announced as reshored numbers, like 287,000 jobs in 2023 were mentioned, especially in semiconductors, EVs, clean energy, partly helped by things like the CHIPS Act and IRA.
So some movement.
Some movement, yes. But the trade-off is real, using tariffs to force it. It disrupts existing efficient supply chains, even if they're global.
Making things potentially more expensive overall.
Potentially, yes. Companies face higher costs for imported materials they still need. That squeezes profits, can make them less competitive globally, and it strains relationships with international suppliers you might still rely on.
So reindustrialization via tariffs might not be a free lunch. It could hurt efficiency and raise costs long-term.
That's the risk. Even for goods made domestically, if they rely on imported components that now face tariffs, the final cost can still go up. It's complex.
Okay, so the EU isn't just sitting back. We know they're preparing retaliation. What else is in their toolkit besides tariffs?
Right, it's that dual strategy. Talk and prepare. They keep pushing the diplomacy, the zero-for-zero offer.
But they have other economic weapons.
They do. We mentioned the $21 billion in approved tariffs ready for July 14th, and the $95 billion list waiting in the wings. But there's also something newer, potentially quite powerful, the Anti-Coercion instrument, or ACI.
Anti-coercion, what does that do?
It's designed specifically to deter countries from using economic pressure or threats against the EU. It gives the EU a whole menu of options beyond tariffs.
Like what?
Things like export controls, restricting access to intellectual property, curbing foreign investment, banning certain services from operating in the EU, even imposing special duties on digital platforms.
So theoretically, they could target specific U.S. sectors, like finance or tech?
Theoretically, yes. They could limit a U.S. bank's ability to bid on EU government contracts, for example, or restrict a big U.S. tech firm's market access.
But they haven't used it yet.
No. There's a process involved, consultation can take months, and there's always the risk that using it triggers even more retaliation from the U.S. So there seems to be some hesitation, some caution about deploying it right now.
It sounds like a high-stakes gamble. What's the EU hoping to achieve by showing this willingness to retaliate strongly?
It looks like a calculation about pain thresholds. They seem to believe that significant targeted retaliation will inflict enough economic damage on the U.S., raising recession risks, hitting specific businesses and voters, that it forces the U.S. back to the negotiating table in a more genuine way.
So brinkmanship, essentially, trying to make the cost too high for the U.S. to proceed.
Pretty much. It's a dangerous game, though.
Yeah.
Miscalculate and you stumble into a full-blown trade war that hurts everyone badly.
What about the World Trade Organization and all this? Isn't the WTO supposed to handle these disputes?
Ideally, yes. The WTO exists to regulate trade, provide rules, and offer a forum to settle disputes. Countries can file complaints, and the WTO system allows for authorized retaliation if rules are broken. But, well, two things. First, the Trump administration showed a willingness to bypass or ignore WTO rulings it didn't like. Second, the WTO process can be notoriously slow.
So enforcement is weak or slow?
It can be perceived that way. So while the framework exists, the current situation, with major players threatening unilateral actions, really highlights a weakening of that rules-based system. It risks shifting towards a world where economic might makes right, which undermines stability for everyone involved in global trade.
This feels like it's bleeding way beyond economics into geopolitics. What are the wider implications for alliances, for global power dynamics?
There's a genuine risk here of what some are calling an irrevocable fracture in trust between the U.S. and EU.
Damaging the transatlantic alliance. NATO.
Potentially, yes. There were already strains, different perspectives on things. President Trump's previous actions celebrating Brexit, the first round of trade wars, suggested less value placed on EU unity, a more transactional view that doesn't always sit well with the EU's multilateral approach.
And if that rift widens, how might Europe respond?
It could really push the EU faster towards strategic autonomy, especially in defense. More talk, maybe more action on an army of Europe. A real psychological shift away from decades of relying on the U.S. security umbrella.
Which could weaken NATO.
It could, potentially leaving it a shadow of its former self, as some analysts worry. It might also deepen divisions within the EU as some countries feel forced to seek accommodation with others, maybe even Russia, out of necessity.
If the West is more divided, who stands to benefit globally?
Well, countries like China and Russia could certainly see opportunities to increase their influence.
How so?
For China, a U.S.-EU trade war might make the EU look for partners who, ironically, seem more committed to rules-based trade, at least rhetorically. We might see China try to strengthen EU ties, maybe redirect some exports there.
And Russia?
Anything that weakens Western unity is generally seen as good for Moscow. If the U.S. appears dismissive of European security concerns, like some interpretations of Trump's past Ukraine comments, it undermines the EU. A divided EU is easier for Russia to exert influence on, maybe picking off member states.
It feels like the whole idea of multilateralism, countries working together through institutions, is really under pressure.
It definitely is. The America First approach challenges that post-WWII U.S.-led order. But, it's unlikely the rest of the world just gives up on working together.
So multilateralism adapts rather than dies?
Possibly. We might see more world minus X scenarios, countries collaborating on issues without the U.S. involved. Think about things like the Paris Agreement after the initial U.S. withdrawal, or the International Criminal Court.
And regional blocs could become more important.
Exactly.
Right.
Regional groups like ASEAN and Southeast Asia, or maybe alternative institutions like the China-led AIIB gain more prominence. The EU itself could become a more central partner for developing nations looking for stability.
Leading to a different kind of world order.
Perhaps moving towards what some call a global multiplex, less dominated by one or two superpowers, more complex, with different power centers cooperating and competing across various issues, maybe what actually reflects today's power distribution better.
So trade policy isn't just about economics anymore, it's a geopolitical weapon.
Absolutely. That's a key takeaway. A U.S.-EU trade war isn't just about tariffs on cars or cheese. It's about fracturing alliances, creating power vacuums that others might fill.
And it goes beyond tariffs.
Way beyond. Think about China controlling rare earth minerals, the EU developing that anti-coercion instrument. Disputes are about critical resources, tech dominance, intellectual property, market access for services. It's broad geo-economic competition, making the global environment much more volatile, much harder for businesses to navigate. Supply chains, capital flows, tech transfer all become potential battlegrounds.
This paints a pretty grim picture for the global economy. What are the big international institutions actually forecasting now?
Yeah, the outlook is definitely soured. The IMF, for example, recently cut its 2025 growth forecast for the U.S. pretty sharply. They've also upped the odds they see of a U.S. recession from 25% to 40%.
And globally.
They've lowered the global growth forecast for 2025, too. And they're explicitly warning these tariffs could push U.S. inflation higher and increase financial instability worldwide.
Is the World Bank singing a similar tune?
Pretty much. They're warning U.S. tariffs, especially with retaliation, could knock global growth down significantly. They also cut their U.S. growth forecast for 2025 if tariffs escalate. And they point to worrying trends: global trade restrictions way up, investment in developing countries down.
What about the OECD, the club of mostly rich countries?
Similar story. Lower global growth projections for the next couple of years, blaming higher trade barriers. They see North America slowing down under tariffs, maybe even tipping Mexico into recession. Slower U.S. growth, higher Canadian inflation, their forecast too.
So across the board, these major institutions are flashing warning signs.
Absolutely. And it's not just them. Private analysts, too. Goldman Sachs raising their U.S. recession probability to 45%. Yale Budget Lab's inflation and GDP impact numbers we discussed. Even consumer confidence is dipping, with tariffs cited as a top worry.
So the consensus is
Brace for impact, basically. Higher prices, slower growth. Some fear stagflation, that nasty mix of stagnation and inflation. A real chance of negative U.S. growth for multiple quarters. We even heard Maersk, the shipping giant, warning global's trade volume could actually shrink this year.
it really feels like a potential turning point.
Yeah, phrases like new era or significant reset of the global system are being used. The trade tensions and the sheer uncertainty are forcing a major rethink.
Okay, wow. That is definitely a lot to absorb. Let's try to quickly boil down the key takeaways here.
Right. So first, these proposed tariffs are a serious economic threat to the U.S., to the EU. History warns us this could end badly.
Second, the geopolitical fallout could be massive. Fractured alliances, a reshaped global order, big shifts in power.
Yep. And third, the major economic scorekeepers, IMF, World Bank, OECD, they're all worried. Forecasting slower growth, higher recession risks globally.
Okay. So to leave you with something to think about, given how interconnected everything is now, our economies, our supply chains, and knowing what history, like Smoot-Hawley, tells us about protectionism, how might a really big trade war like this one could change things in ways we haven't even considered yet?
Yeah, beyond just the price of goods.
Right. How does it reshape daily life, global stability? What are the unforeseen consequences down the road? Definitely something to mull over beyond the headlines.
Absolutely.
Thanks for taking this deep dive with us today.
Transform your trading with Forex Analytics' new platform. Introducing the complete market analysis platform, precision analysis, real-time insights. Subscribe today and save 40% on monthly subscriptions. Join us now and elevate your trading strategy.